Real estate developer Don Peebles has told us right here on The Exchange he's seeing big opportunities in Miami as well. Joining us for more on that is Stephen Bittel. He's founder and chairman of Terranova, the largest property owner on Miami's so-called Miracle Mile. And for those of us still stuck in the Northeast, Stephen, what is the Miracle Mile? Tell us everything. Where are your properties? Where is some of the development in the city happening these days? Are you seeing any slowdowns?
So development in the city is happening everywhere, really across the board, from corner to corner, north to south. Terranova is the largest retail owner on Lincoln Road in Miami Beach, as well as the largest owner on Miracle Mile and Coral Gables, our two most important high streets in Miami-Dade County. And Ken Griffin may have it right. We saw a huge volume of relocations early in the pandemic of billionaires, and they brought their companies right afterwards. And now we're starting to see the second wave of their executives and the law and accounting firms that service them. So we have never been more excited about our commercial real estate future here, which is unlike almost everywhere else in the country.
And when you say commercial, are you talking office, retail, both, other things?
So we're invested in office, retail, industrial, and multifamily. All of them are performing at record levels right now, with occupancy rates and rental rates the highest we've seen in 20 years.
We had a guest on earlier this week, Kevin Maloney, I believe is his name, and he is exposed to a lot of luxury condos in Florida, and I'm not sure if it's in Miami per se, but said that there's been so much inventory coming on the market that prices are starting to soften and properties are starting to sit. Some projects, he said, are even stalled. Is that true in Miami?
Most of the projects that didn't get started before interest rates ran up and debt capital became less available have stopped before they began. The developers are holding on to the land. Rental rates have flattened out. We've had a record amount of deliveries in multifamily. And after 3 years of skyrocketing rental rates, things have kind of flattened out. We're not seeing a lot of incentives yet for tenants to move in, but we think that could be coming. This may be the only office market in the country that people are building new office buildings. And our occupancy and rental rates, again, are at record levels.
So should we expect commercial real estate owners to run into any problems on rates alone, for instance, when they have to do those calculations or maybe face maturities in the next year or two? Or do you think they're going to be, unaffected or make it through okay?
It really depends on how well capitalized the property owners are. No question that people that had variable rate mortgages have seen more than rates run up from 3% to 7.5%. People with fixed rate mortgages that have maturities are seeing a meaningful increase and a re-underwriting. It's going to require them to either pay down the debt or to give it back. At the same time, occupancy and rental rates for the better buildings have gone up meaningfully. So there's a tension there, and it'll be a tale of different owners getting different performance. We bought an office building 4 months ago, and we're able to get a 60% loan to value mortgage and came in with the rest with a big chunk of equities. That building has continued to lease up at rental rates above projection. So every owner has a different story. The biggest crisis we face is the small and mid-sized banks are really out of business in terms of new debt. And they are the primary lenders to small and mid-sized businesses. They claim that the Fed is pressuring them to shrink their loan books. And as long as that's going on, that's a risk factor that we face.
Can private credit, private equity, those kinds of firms step into the void?
There's no question that the hard money lenders have shown up with rates at 10 to 15%, meaningfully different than where we were used to borrowing from the banks. We have not been a borrower from those sources, but most of the market, as they have maturities, are considering some of these lenders.
You said that with a slight smile, if I might have discerned that. Is there a reason? Is that a good thing to you? Do you think that if people have to turn to those sources, they are going to pay maybe a little bit more than they might feel comfortable doing?
I guess the smile was, look, we were prepared for this storm. We had several large liquidity events at the end of 21, and we patiently waited. So we have a 42-year history as a company, and a balance sheet that was built to ride out storms like we are experiencing right now. So these usually are the moments of greatest opportunities for well-capitalized, experienced operators.
All right, Stephen, thank you so much for joining us. Appreciate it.